So good afternoon, everyone. Welcome to today's program. My name is Gary Sarkissian, and I'm the Director of Education and Content at CFA Society Boston. We're very excited to bring you today's presentation. In fact, some of you have been waiting for this program since early spring, which feels like a long time ago. As you all know, the debate surrounding the merits of value investing has received quite a lot of attention lately, with today's market environment casting doubt on this investment strategy and fueling bold claims such as value investing is dead. That said, traditional value-based strategies of buying stocks on the cheap relative to their assets and income have not worked well lately. More broadly, and as further emphasis to this last point, the Russell 1000 Value Index underperformed the Russell 1000 Growth by approximately 300 basis points per annum from April 2009 through the end of 2019. Year to date, and even after factoring in the recent tech-led sell-off, growth outperformed value by a whopping 3,200 basis points. Of course, we have seen this sort of discrepancy in performance back at the height of the dot-com bubble. So is this time different? Has value investing been rendered obsolete? What is the most intelligent way to move forward? Here at CFA Society Boston, we have also participated in this discussion in one form or another. Today, we are fortunate to be joined by none other than legendary value investor, author, and Columbia Business School professor, Joel Greenblatt. Joel is managing principal and co-CIO of Gotham Asset Management, which is the successor firm to Gotham Capital, an investment firm he founded in 1985. He has penned the following books: You Could Be a Stock Market Genius, The Little Book That Still Beats the Market, The Big Secret for the Small Investor, and just recently, Common Sense, The Investor's Guide to Equality, Opportunity, and Growth. In addition, Joel has served in the role of an institutional allocator on a number of investment boards, including the University of Pennsylvania and UJA. Furthermore, since 1996, Joel has also been on the adjunct faculty of Columbia Business School for over 2 decades, where he teaches value and special situation investing. Joel holds both a BS and an MBA from the University of Pennsylvania's Wharton School of Business. Also joining us today is Adam Barth, Gotham's Director of Equity Research. Adam joined Gotham in 2005, where he has helped build the firm's analyst team and expand its research efforts. Adam holds a BA from the University of Pennsylvania and a JD from Duke University's School of Law. Now, before we begin, I do want to remind the audience that you are in listen-only mode. After the presentation, we will open up Q&A. If you would like to submit a question to our speakers at any time during the presentation, please use the Q&A button at the bottom of your Zoom webinar session. By the way, as a token of appreciation for today's attendees, the team at Gotham is happy to offer complimentary copies of Joel's books, The Little Book That Beats the Market and The Big Secret for the Small Investor. We will have more information later on in the webinar on how you can obtain your copies. So without further ado, Joel, welcome. We're happy to have you, and please take it away.
Thanks so much, Gary. I hope everyone can see me. Sorry I'm not here in person. Apologize for that. It would be nice to get together soon, but I appreciate you joining online. So the name of the speech is The Evolution of a Value Investor, and I think that's a good way to put it. I was asked to give a speech a few years ago about value investing, and the question was the same: is value investing dead? And my response was pretty straightforward. I said yes, then I said no, then I said maybe, and then I said I don't care. And all of those are true in different ways, and we'll get to them soon. But just to jump the gun for a second, stocks are ownership shares of businesses that we value and try to buy at a discount. So a value investor values a business, tries to buy it at a discount. As Warren Buffett might say, growth and value are tied at the hip. Not even might say, he does say that. And that's part of valuation, and we'll get into that over time. But it's certainly true that traditional measures of value have underperformed, and I'll go through some of those numbers later. They're pretty phenomenal, and we'll talk about the ramifications of that going forward and what the opportunity set may look like going forward. I guess I got started in value investing because I went to Wharton in the late 70s, and the rage was teaching about efficient markets. And that's all they really wanted to listen to. It didn't really resonate with me. And then one day, luckily, I read an article in Forbes about Ben Graham's stock picking formula. Turned out his stock picking formula, which he had been using for decades, was buying stocks below their liquidation value, taking their current assets, subtracting all their liabilities, ignoring all their fixed assets, and then trying to buy stocks that sold beneath that value, effectively ignoring all fixed assets, just current assets minus all liabilities, kind of gave you a quick and dirty liquidation value. We did a study of it. Clint put up already our master's thesis I did with my good friend Rich Bazzino, who runs a $30 billion value fund, used to run Sanford Bernstein's US equities, and my good friend Bruce Newberg. We did this together back in the late 70s. And of course, computers and data weren't that available. We actually used the DEC 10 computer that Wharton had, which filled up about 3 classrooms worth of space. We didn't have a database, couldn't afford one. There really weren't very many good ones. We actually took out the old Standard & Poor's stock guides and went stock by stock. We only got through the A's and B's as a random sample, but we went through about 10 years of data just manually. So you can imagine what was involved there. And we showed that Graham's formula, just buying cheap effectively, stock selling below liquidation value, still worked incredibly well. So that got us pretty excited about value investing. And I actually, out of school, went to work in all places at a risk arbitrage firm, which is betting on whether mergers go through. And I actually hated that business. If you don't know what risk arbitrage is, you're betting on whether mergers are going to go through. So when they go through, you make $1. If the merger falls apart, you lose $10 or $20. So I never liked that risk reward. So I spent most of my time at that job. That was my first 3 years on Wall Street, trying to get out of that business, meaning looking for weird securities that were giving out in a merger, special things that were going on, something that was going to be spun off, or some way to get out of the business where I was going to make $1 and lose 10 or 20. And I was looking for all kinds of off the beaten path types of securities, and that led me to be a special situation investor. And when I started my own firm in 1985, Gotham Capital, that's really what we did. We were looking for spin-offs and special options or rights offerings, leveraged stubs, stocks coming out of bankruptcy. I actually wrote a book, You Can Be a Stock Market Genius, was really a, I would say, series of war stories that we went through in the first 10 years of Gotham Capital. I started in 1985, Gotham Capital, with about $7 million. For our 10 years in business before our fees, we averaged 50% a year returns, investing in these special situations. And it was pretty Wild West. And, you know, people say, how can you make 50% a year before our fees? Keep in mind. And I really boil it down to 3 things. One, stay small. So after 5 years in business, we returned half our outside capital. After 10 years in business, we returned all our outside capital. So stay small, concentrated. 6 to 8 names were traditionally 80+% of our portfolio. And then if you're that concentrated, you have to be lucky. So I can't really teach you how to get lucky. You can certainly put the odds in your favor, but it was really good that we were lucky with such a concentrated portfolio. But we used our same basic value investing principles, which is value a business, figure out what something's worth, pay a lot less. We just went to places off the beaten path where we'd have a little bit more of an edge. And if you're interested in that kind of investing, I wrote You Can Be a Stock Market Genius, really went through the types of things that we looked at. Still very proud of that book. I highly recommend it. My living is not making $1 or $2 selling the book. So, you know, I hope you think about it as just my way of giving back. I learned from reading Ben Graham and Warren Buffett, and people were willing to share what they knew. And I tried to do that, and You Can Be a Stock Market Genius. I'll give you one example of the types of things that we did there. In the early 90s, Wells Fargo, once again, was having problems. Flash forward to today, nothing like that. It was a very good bank. Even Warren Buffett even owned it back then. But there was a big real estate recession in the early 90s in California. So bad, in fact, that there was a question whether Wells Fargo was going to make it. The stock had normal earnings power of about $16, and at that time, a reasonable bank would trade at about 10 times its normalized earnings. But instead of trading at $160 a share, Wells Fargo was trading at 84. The reason was it wasn't clear whether their portfolio, heavily concentrated in California, was going to make it, whether the bank was going to make it. So it was at $84, the stock was priced kind of 50-50 that they'd make it. 50% it goes to zero. 50% if they made it through with $16 in earnings power, you're up at 160. I actually thought that it was at least an 80 or 90% chance that Wells Fargo was going to make it through that recession, given their earnings power, given the way they underwrote their portfolio. But what I wrote about, and You Can Be a Stock Market Genius, and you can look it up yourself, was I found a leap, which is merely a long-term option. That an option to buy stock at $80 a share in Wells Fargo that expired 2 years later. And that warrant was trading at $12, that option was trading at $12 a share. So the right to buy stock in Wells Fargo at $80, 2 years from now was trading at $12 a share. So just real quickly, if you bought the stock at $84 and it went broke, you'd lose it, $84. If it didn't go broke, you double your money. All right, so 80 down, 80 up. Pretty good in the stock. Now think about an option. You bought an option to buy stock anytime in the next 2 years for $12, struck at 80. So if Wells Fargo made it through, the right, and the stock went to 160, the right to buy Wells Fargo at 160, where you only had to exercise at 80, would be worth $80. You paid $12 for an option that could be worth $80. And if Wells Fargo went broke, you'd lose the $12 you put up to buy the option. So now you turn the risk reward from $12 down and $80 up, or $70 up actually, because you paid $12 for your option. So you really change the 1-to-1 risk reward to closer to 7-to-1. And I consider ourselves a value investor. So we're buying options. We're buying in a risky stock, but we turned something where I thought it was 80-90% the stock was going to make it. And if it did, we would make 7-to-1 on our money. So that's really being a value investor. It's limiting. And the way we look at buying value positions, we're really looking at, when I size them, how much I could lose, not how much I could make, how much I could lose. And I knew exactly what I could lose, the $12. So anyway, that's the type of thing you might want to read about. You Can Be a Stock Market Genius. And we did that for a long time. My partner, Rob Goldstein, is still with me 30 years later, joined us in 1989. And he's a big part of what has made Gotham successful over the years. And so he's been a great partner over that time. So I started teaching in 1996 over at Columbia. And in the early 2000s, I wanted to prove, much in the same way we had written that paper back when I was in business school, proving that Ben Graham's methods works. I wanted to prove that that what we had evolved into, buying good and cheap businesses. Ben Graham said, figure out what it's worth, pay a lot less, leave a large margin of safety. Warren Buffett made that little twist that made him one of the most richest people in the world. He said, if I can buy a good business cheap, even better. And so buying a good business cheap, we had evolved more to that than just buying cheap, like buying stocks, as Warren Buffett would say, cigar butts, which were the liquidation value stocks. And we wanted to prove, Rob and I, that what I had been teaching my students, what we had been using to make money, buying good and cheap, worked just as well. We hired our first programmer in 2002. We hired a head of research, Adam Barth, in 2005. And if you turn to the next slide, If you can, Clint, page 3, there you go. We did a study, and pretty spectacular study. It was the very first study we did. We just said, you know what if we used a crude database, crude metrics to try to figure out which stocks are cheap and which stocks are good. We use return on tangible capital. I'll get into that detail later if someone wants to know. I wrote it up in the little book that beats the market. But basically, we wanted to test, just like we had done Graham's method, buying good businesses that earn high returns on tangible capital and cheap businesses based on a simple metric of cash flow. Another way, and we did very crude metrics. I tested that, and the results were so good, I wrote it up in the little book that beats the market. And that was the very first test we did. We did not spin the computer thousands of times to figure out a formula that worked very well. It worked incredibly well. And what came out of that was what we're actually doing today. We don't use crude metrics. We don't use crude databases. Rob and I looked at each other after we saw the results of that very first test that I wrote up in the little book that beats the market. And we said, you know what? We know how to value companies. We know how to actually do the work. We don't use crude metrics. We don't use crude data. And we can show, but even using crude metrics and crude data works so well, we thought we could do a lot better. And this chart you're looking at tells you how much better and how powerful just valuing businesses and trying to buy at a discount. I'll explain this chart in a second, but let me explain how we got here. The best example I usually use is you're buying a house. Everyone's familiar with that. I mean, to make the numbers simple, I'll assume you're paying $1 million for the house. You're looking at the house and you're deciding whether you want to buy it at $1 million. And your job is to figure out whether it's a good deal or not. There are a few questions that you would ask whether you want to buy that house. One question might be, gee, if I rented out that house, how much would I get for it? And if I could get $70,000 or $80,000 in rent for that house, it might help me justify, right? 7 or 8% yield on that $1 million house. It might help me justify buying the house. The other thing I might do is look at what are the other houses on the block going for? And the block next door and the town next door. How relatively cheap is this house relative to the other similar houses? And we do the same things for stocks. We say, how cheap is this business relative to other similar businesses in the same industry? How cheap is this to all businesses we can buy? How cheap is this being priced versus history? We say, if we buy this business, what kind of yield am I going to get that business on normalized earnings? Am I going to make 7 or 8% at some point in the near future? How much is that going to grow? These are all the questions we ask. And this chart you're looking at is sort of a proof of concept, similar to what we did for Ben Graham. This is buying good and cheap businesses. Okay, so the x-axis is a 30-year study ending the end of 2019 for the 30-year period. The x-axis is our valuation percentile. So we looked at the 2,000 largest companies in the United States. We ranked them from 1 to 2,000 based on their discount to our assessment of value, our measures of absolute and relative value that I just described, like you're buying a house. So if you fell in the first percentile, you'd be the 20 companies out of the 2,000 largest. This is on the x-axis. You'd be the 20 companies out of the 2,000 largest that measured cheapest at any particular time. If you fell in the 99th percentile, all the way on the right side, you would be the 20 companies that were measured most expensive on any particular day. If you look at the y-axis, that's the year forward return of stocks in each percentile. So we rank the companies from 1 to 2,000 on a daily basis. We rank them in order. And what this chart says, over the 30-year period that we studied, ending at the beginning of 2020, stocks in the first percentile, the cheapest companies, averaged a 1-year return of 23%. Stocks in the second percentile averaged a little less. And as we measured something more expensive and the percentiles went, the year forward return dropped. So you can see how linear it is. So that just says if you buy cheap companies based on measures of absolute and relative value, you do better over the next year than if you buy expensive companies. That's what the results were over the last 30 years. And if I were in my class at Columbia, and if I asked someone to say, hey, do you see a long short strategy you might pursue if you could predict ahead of time which stocks would do best, second best, third best in order? And you didn't say, I guess I'd buy that upper left-hand corner and short that bottom right-hand corner. I'd have to throw you out of class because that's what this chart says to do. Now this fit, if you see the best fit line is about 0.9%. That's pretty incredible over a 30-year period. It says the way we value stocks is approximately how the market values them over time. And I actually promise my students first day of class, if they do good valuation work, the market will agree with them. Unfortunately, I never tell them when. You know, that could happen in 2 or 3 weeks, could happen in 2 or 3 years. So the problem with this chart that looks so beautiful over a 30-year period is that if you looked at a 1, 2, or 3 year period, it wouldn't look so beautiful. If what we did worked every day and every month and every year, everyone would do it, it would stop working. If you looked at a 1 or 2 or 3 year period, it wouldn't be a 90% fit. It would be 0.55, 0.6. It would be a nice fit, but pretty messy. And that's what makes it keep working. It doesn't work every day and every month right in order. The cheapest stocks do the best, second cheapest, second best in order. But on average, that's how it works over time. Now, that is not what's happened, as we'll discuss later, most recently. So it is very interesting. One thing I do want to share on the next page, we actually took this chart and actually set up funds to take advantage of it. And I want to share something. If you see on the bottom left-hand corner here, we have a fund called Gotham Enhanced S&P 500 Fund. And what that fund's done is just take advantage of the cheapest stocks. You know, in this fund, we rank the S&P 500 from 1 to 500. And the S&P 500 is pretty, has done very well, as people know. But the most important thing about the S&P 500 is if you view the returns of the S&P 500 as market returns, then it never underperforms the market. It always does exactly average. And that's very good because investors aren't shaken out of the fund. I wrote a book called The Big Secret in 2011. And I always make the joke that it's still a big secret because no one bought it. You saw Gary said we're giving them away. So, you know, please feel free to get your copy. But in it, I wrote a study of the best performing fund. I wrote it in 2011 from 2000 to 2010. The fund was up 18% a year. The market was flat during that decade. But the average investor in that fund managed to lose 11%. And the way they lose 11% on a dollar-weighted basis is that every time the market went up, people piled into the fund. When the market went down, they piled out. When the fund outperformed, after it outperformed, they piled in. After it underperformed, they piled out. Right? To make 18% a year when the market's flat, your returns are going to zig and zag pretty wildly versus the market. And so the average investor in that fund managed to take that 18% annualized gain when the market was flat and turn it into an 11% annualized loss on a dollar-weighted basis, meaning they went in and out at all the wrong times. So what we did here in the Enhanced S&P 500 fund is we just said we're going to buy all 500 stocks in the S&P 500. And if we believe, based on our valuation metrics, that something is cheap, we'll buy a little more of it, just a little more of it, because we don't want to have too much tracking error and have people leave at the wrong time. And if we think something is expensive, we'll buy a little less of it than what's in the S&P 500. And this fund, in a very tough period for value investing, has outperformed the market. It's a 5-star fund. And so you can see that upper left-hand corner during this really tough period for the market, and I'll go through the data in a second, has outperformed the market. So really, in the sense that we're looking at value investing, figure out a business's worth in a more sophisticated way than just low price book, low price sales, which we'll talk about, has actually worked on the long side. On the short side, I'll just give you a little data point. Last year, and this is before COVID, if you bought every stock with a market cap over $1 billion that lost money, in the first 6 months of 2020, you'd be up 47%. That means if the company lost money in 2019, nothing to do with COVID, and you bought it, you bought every single one with a market cap over $1 billion, you'd be up 47% in the first 6 months. So you can see the bottom left right-hand corner where you're buying expensive stocks, things that are selling at hundreds of times earnings or actually lose money. Those have been pretty good performers. So long short hasn't worked so well, but even in this tough value environment, just our definition of value, figuring out what it's worth, paying a lot less has still continued to work. I'm just going to give you a little bit of where the market stands right now, according to our data. We go back 30 years, look at the market over that period. And what I will tell you is that the market measures right now in the 7th percentile. We bottoms up value the S&P 500, every stock over 30 years, and then compare where we are today. Right now, it shows us in the 7th percentile. But of course, the second quarter this year was significantly hurt abnormally by COVID. So if we just look up, we were in the 12th percentile at the end, based on 2019 numbers. Market's up about 5% or so since the end of the year. If we just use 2019 numbers, we're in about the 10th percentile towards expensive using those metrics over the last 20 years. And expectations would be low single digits over the next year based on past history from here, high single digits over 2 years over the next year or two. And that's where the data is showing. The Russell 2000 is in the closer to the 1st percentile, been cheaper 99% of the time over the last 30 years. That's extraordinarily expensive, with expected returns from these levels negative. All right, so that's the big picture right now. But, you know, obviously, second quarter has been particularly interesting given COVID. And I wanted to give Adam Barth, our head of research, a chance to talk about what he's seen in this difficult period to really contextualize where we stand today. So Adam, why don't you take it away for a little bit? Well, I'm going to keep talking until Adam gets on. Adam, it shows you muted.
Yeah, sorry. Okay, can you hear me?
I can hear you fine,
Yeah.
Adam. Go ahead.
Okay, great. Okay, so on the screen is an example of some of the issues that we've wrestled with more recently, given the tumultuous environment that companies are operating under in the first half of this year. So an example I'm giving is a company that generally has fairly vanilla financials as it relates to what we look at. And I guess I should reiterate or iterate in terms of what it is that we look at. Well, we're interested in virtually everything that occurs on an operational basis, and the framework that we employ is to measure operational performance in its own right. And so that's a very different take on accounting for companies, in the sense that GAAP is done with mashing everything together, everything from operations to tax, financial issues, and so forth. So we want to strip out what's occurring purely on an operational basis, and then come to our own notion of capital structure, and then assess, you know, the vibrancy of the operations in the company as it relates to the all-in cost of owning a business, be it against assets that aren't represented necessarily in the form of, let's say, cash equivalents or ownership shares that aren't consolidated in other entities, things of that sort, to liabilities, everything from environmental liabilities to pension liabilities, anything else under the sun. So Bristol Myers, like a lot of large cap companies, tends to be a little bit more straightforward in the accounting issues. That said, like a lot of companies, there are issues brought to bear by COVID. And so we're asked to make some more choices as it relates to the way companies represent the issues that they face within the environment. So we can scroll down a little bit. It looks a little bit like an income statement here in our own notion of what's income. And when you see it sort of towards the top is something that looks a little bit more like what would be, call it sell side or standardized Standard & Poor's numbers. We don't use them, but they're merely a reference point in terms of that we have here as one of the many checks, bells and whistles we have in terms of looking at our own take on numbers. And it's a very different number that we have, which is down here in terms of the number that we have for the companies. And so few issues for Bristol Myers within the course of this year. Just for those who aren't necessarily familiar with the company, they consummated a very large acquisition in Celgene a few quarters ago, and thus the numbers for the company in terms of sales and so forth are up significantly. If you look year on year, sales went from 6.3 billion to 10.1 billion. And so even before we tackle the COVID issues, there are a bunch of other issues that are sort of stock to what we do that come to bear in major transactions, especially within the pharmaceutical biotech space. So you see down at the bottom, you see an adjustment we have for amortization of intangible assets. And so I don't know how many in the audience are familiar with some of these more arcane accounting issues. So the issue here is that if you look on GAAP, they made a sort of an agreement 20 years ago when they decided not to do pooling of interest for acquisitions anymore. And so what they had to do in terms of not allowing for goodwill accounting anymore was a compromise was made in terms of companies would have to amortize a certain level of intangibles. Now, this is pretty broad in terms of what an auditor is going to bring in a deal. The short of it is that auditors are rarely willing to put everything into goodwill, and that's part of the nature of the way things work. But you frequently get a lot of distortions in terms of what's amortized. The choice that's usually made, if you look at, let's say, standard numbers like Standard & Poor's or sell side, will ignore this amortization. Very frequently, we would say that's not the right choice, and that for companies that are highly acquisitive, they're usually using these acquisitions as a substitute for internally generated assets that are later brought through the income statement. In the case of this acquisition, you have the opposite effect. So they have to recognize a huge level of amortization as it relates to what is the actual economics of Celgene. So the best example I have is that years ago we had a company that we followed called Warren Chilcott, and it was in our universe of names, a specialty pharma name. It was bought out, I think, by Bain, and then a year or two later it went into public markets again. Nothing changed about Warren Chilcott except for the fact that it temporarily was owned by private equity. As a result of having been written up by private equity, the income statement looked radically different because they had to amortize the value of the premium paid. It has nothing to do with operating a business. So in the case of Bristol Myers, to be really simple, they spend about 20% of sales on R&D, which is relatively high for a major pharma name, but that's not recognized at all. So they have to recognize all this excess amortization that if I don't want to get too long-winded about this, has nothing really to do with the business as it compares to other names, let's say like Merck or Pfizer. It's simply because it's a combination of names. And so in the way we look at companies, which is how much operational free cash flow they throw off, we add back this amortization, and that it doesn't really relate to the way in which the company operates. The second adjustment here, it lists royalty and licensing income. So all types of interesting royalty income and licensing income doesn't get recognized for Bristol Myers for a variety of different reasons. One, they had a deal a couple of years ago with AstraZeneca in terms of royalties on a drug. And then they also, I believe they settled a deal with Merck, a legal suit a few years ago. And Merck has to pay them for an extended period of time based upon royalties on patent infringed drugs. And so this is real part of the business, long-standing with long duration royalty income in the business, but it doesn't get necessarily recognized on a consolidated basis or something you'd see through in terms of how most people would recognize income. Pretty common sense stuff to us, but that's just orientation. We don't care about GAAP. What we're trying to do is redraw the accounting in a more sensible way. But back to the COVID question, it's a tricky one. So in the case of Bristol Myers, they were to introduce some new drugs to the market in the first half of the year. And for a variety of different reasons, there were delays in terms of how this would get out to market relating to the medical system in our country and use of non-COVID related treatments. And so approximately $250 million of sales didn't show up in the quarter. It's probably going to show up in the next quarter, at least based upon the way Bristol Myers describes it. We're not going to redraw sales. It's a little beyond the pale for us. But they did incur also another $200 million in terms of sort of pre-marketing for some of the newer pharmaceuticals at issue. And this is where you get into a little bit more of a question of art. And so the decision we made ultimately here was not to add these costs back, even though that they're not able to realize revenues on some of these newer drugs, for the fact that in terms of our overall look at the income statement, we think we're fairly generous with regards to some of these add backs, even though I would say they're all reasoned. And you know, I think our biggest issue at the core is comparison. So things aren't done in isolation. We run portfolios with certain exposures for investors, and our job is to pick the best names we regard on the long side on a valuation basis, and short names we consider to be the most unattractive on a valuation basis. And this means that you need to be extremely consistent in your process. And to be realistic, vast majority of companies face some sort of fixed costs within their business within this first half of the year that wasn't necessarily commensurate with their expectations for sales, obviously with exceptions like certain places in terms of software and technology. And so on a like-for-like basis, and in that it wasn't highly material for the company given the scale of EBIT, we backed off on that. But you know, just to give flavor for some of the issues at hand with regards to both everything from sales recognition to cost recognition for you know, a fairly vanilla large cap company like Bristol Myers. But we can toggle back to some of the, if there are any questions later on in terms of Gotham's approach in the Q&A section, but that's just a little bit of flavor of what it is that we do in general.
All right, so thank you so much, Adam. Clint, why don't we go to the next slide? Yeah, I'm just gonna wrap up before we take questions with some really incredible data. Keep going, yeah, that's it. No, yeah, that's it. Okay, now we got the right slide. All right, so this is a study we did, and this is really interesting because we're back to, you know, is value investing dead? Does it make sense? And this is a really fascinating chart because it's not a chart of Russell's definition of value or growth with low price book, low price sales. It's really our valuation methodology, like where private equity investors ranking companies. This is a study from January 1990 to June 2020, so a little over 30 years of our ranking methodology, like I showed you with the chart with the 90% fit over time. This takes the 2,000 largest companies in the United States, and every year we buy the cheapest quintile and we sell the most expensive quintile. So we assume you buy the cheapest quintile, you subtract the return of the most expensive quintile, and then we rank the years. This is just merely a ranking. We rank the 30-year period between what were the best years for cheap minus expensive and what were the worst. So you can see from this chart that 1999 has no bar. And so 1999, in the middle of the internet bubble, or towards the end of the internet bubble, was the very worst year for cheap minus expensive. That's the year it didn't work at all to buy. And this is our methodology once again. This is not low price book, low price sales. But then we see 2000, 2001, 2002, 3 best years of all time for cheap minus expensive, meaning a huge reversal right after the internet bubble back towards value. So that's encouraging. And I'll just give you a little anecdote. When Rob and I were running Gotham Capital back in 1998, I had started the firm in 1985, and we had never had a losing year. In 1998, we were continuing to do what we always do, but that was our first year we lost money. We were down 5% in 1998. That was particularly painful because the market was up over 28% that year. Market didn't like what we were doing, that's for sure. In 1999, market was up another 21%. We were down another 5%. All right, so that's two, with no losing years before then, we had 2 losing years in a row. In 2000, the market was down 9%. We were up 114%. So we weren't idiots in 98 and 99, or at least I don't think we were, and that's why we were down money. Just the market didn't recognize the work we were doing. In 2000, we didn't all of a sudden become geniuses and make over 114%. We just got paid for all the hard work we did in 98, 99 and being patient. And so now let's fast forward to the most recent years. 2017 was the 10th percentile. 2018 was the 13th percentile, meaning a terrible year for cheap minus expensive. Now, 2018, cheap minus expensive was about 0, meaning there was no difference between the two. Since they usually win, cheap usually beats expensive. In that year, it didn't really. So that puts it as one of the worst periods for cheap minus expensive, but it really wasn't that bad, just to contextualize. 2019 was the second worst year of cheap minus expensive other than 1999. And 2020 through the end of June is actually the second worst of all time, after 99. So you can see that we've had a period of underperformance for even our definition of value. And so the question is, will there be a reversal like there was in 2000, 2001, 2002? I'll show you some more stark numbers, which are pretty amazing. If we look at the next chart. Take a look at this chart. Let's go look at the growth minus value column 4. Okay? This shows that from the 5 years ending August 2020, growth beat value by 13% per year. In the 5 years leading to the top of the internet bubble, growth beat value by 11%. So actually, more outperformance by growth over value now than in the internet bubble. If you go to the next line, you see the last 3 years, growth beat value by almost 20% over the last 3 years. In the 3 years leading up to the top of the internet bubble, it was about 17% a year. And if you go to just the last 12 months, growth beat value by 43%. This is Russell's definition of growth and value. I mean, it's low price book, low price sales type, investing in value, and growth, not worrying too much about price on the growth side, but growth's being valued by 43% in the last 12 months. At the very top of the internet bubble, it wasn't quite as bad, 34%. So the question will past be prologue. So these are fascinating statistics. But now let me contextualize them, because this is very, very important. And let me explain it to you this way. It's very clear that a factor like momentum has worked well for the last 30, 40 years, not just in this country, but across the globe with 1 or 2 exceptions. I can't argue with it. We're not momentum investors, but momentum has worked over long periods of time. But what if it didn't work over the next 2 years? Well, in 2 years, we could say it didn't work, but it works over the long term. We should just be patient because it works over the long term. Or it could be that it's not so hard to figure out a stock used to be down here and now it's up here. It's got good momentum. And the trade has become crowded and degraded because everyone knows momentum's worked over a long period of time. It got to be a very crowded trade. And that's why over the next 2 years, it does not work. 2 years from now, I won't know the answer to that question. Is momentum just out of favor and it's cyclical and we just have to be patient, it works over the long term? Or is it a crowded and degraded trade? Okay, now let's go to our definition of value, which means figure out what a business is worth based on its normalized cash flows and how much they're going to grow, just like a private equity firm would. It's possible the market does not recognize that and they keep buying stocks that lose lots of money, even though history has shown that's not a good idea. But let's say that over the next 2 years, figuring out what a business is worth and paying a lot less, assuming you're pretty good at that, the market doesn't recognize that and it doesn't do very well. Am I going to stop doing that 2 years from now? No, that's what stocks are. They're ownership shares of businesses that you value and try to buy at a discount. I'm not going to stop doing that. Will low price book, low price sales investing continue to work? I think historically it's worked before the last decade or so, because if you buy a company selling pretty close to a historic cost of its assets, well, it's likely to be out of favor. The market's not giving any value to, increase in value above the cost of the assets. And so if you buy a bucket of companies that are low price book or low price sales, you're likely to get more than your fair share of companies that are out of favor. Okay, and what I would call that is a correlation, meaning that has tended to correlate with good returns in the past. Momentum has correlated with good returns in the past. All we care about as value investors, our definition of value is causation. And causation is stocks or ownership shares of businesses that we value and buy at a discount. So the valuation of the business to us is causation. Correlation would be metrics or factors like low price book, low price sales, and momentum. Those are factors that have correlated with good returns. All we care about is causation. And that's what stocks are. They're ownership shares of businesses. So it makes life very clear about the question, is value dead or not? That type of valuation work is not dead, will never be dead. That's what stocks are, ownership shares of businesses. And once again, as Buffett said, value and growth are tied at the hip, okay? All those definitions of momentum stocks or growth stocks or low price book, low price sales, those are just factors that have correlated with good returns in the past. There are reasons for it, but will it continue? Yes, no, maybe, I don't care, okay? Will valuation work? Stocks or ownership shares of business work. If you do good valuation and buy at a discount, leave a margin of safety, as Warren Buffett said, and Ben Graham said, that will continue to work. And that's why I'm not too worried about traditional measures of value. I really think if you really think about stocks as not pieces of paper that bounce around, that you put Sharpe ratios and Sortinos on, but ownership shares of businesses, and then act accordingly, we don't have to answer questions like, is value investing dead? But I'm happy to take any of your questions. And we can start the Q&A right now if you have any. Thanks for having us here today.
Joel, thank you for that presentation. That was really, really helpful. And we're going to go ahead and switch it over to Q&A. Now, just as a reminder to the audience, if you would like to ask a question to the speakers, there's a little Q&A button at the bottom of your Zoom webinar session. You can submit your question through there. We'll try to get through all those questions as best as we can, just given the limited space of time that we have today. Joel, I wanted to kind of open things up and just kind of focusing in on the title of this presentation, The Evolution of a Value Investor. And I think you have a very elegant definition, and it's Ben Graham's definition: find out what something's worth, pay as cheap of a price as we can to build that margin of safety. But if we think about value investing as an art form, it has evolved over time. When you start with Ben Graham, it was very conservative. Look at the liquidation value. What is the margin of safety? Then Buffett comes in, and he was an acolyte of Ben Graham, but he was also influenced by Charlie Munger. And as you had mentioned earlier, rather than buying an ordinary business at an extraordinary price, buy an extraordinary business at a fair price, if you will. It's probably not the exact saying there. But my question now is that, with all the research that's coming in, and now we're seeing how even Buffett himself isn't now starting to go outside his wheelhouse and investing in tech firms. What do you think the definition of value investing what do you think that definition has to be going forward in order to continue this evolution and for one to be successful in the market? Because as you mentioned, a lot of the strategies that may have worked back then, today is a different environment. I'm just curious to hear your thoughts about that.
Sure. So, you probably wouldn't think that a value investor would like companies like Amazon, Google, Microsoft, Facebook, because they trade at what would be considered traditionally high multiples. I don't think that's where the froth in the market is today. Those companies are some of the best companies of all time. Traditionally, when a company got to a certain size, even though they had an advantage for a while, always people would become shooting at them, and they haven't lasted for a long time. Given the franchises these businesses have, I don't think we've ever seen the network effects the scalability of the businesses, the advantages that these great businesses have. A value investor could say, given the growth prospects and the quality of their franchise and a lot of other things, whether it's Apple, Google, Microsoft, Buffett owns Apple, and what's going on there? Well, Apple is really the gateway to, what people use as the gateway to the internet right now, and pretty much everything. They have a really good spot there. It's got a great franchise. You could, it's not that different than what, Buffett has invested in the past. Facebook has an incredibly powerful advertising engine that, could expand the advertising business greatly. It's not been a fast growing business, but, we've never been able to do the type of targeting that we've been able to do and have access to, billions of people and their, sophisticated algos to meet them. Microsoft, has a leading position in the cloud and is a low cost producer. So there's a lot of great franchises in there that'll be growing for a long period of time. I think when I mentioned that there were, billion and over companies where if you just bought all of them, they're up 47%, that were losing money. That's where I think the fraud are. We're short hundreds of names in our short book. There aren't hundreds of names that rhyme with Amazon, Google, and Facebook. And I think people are pricing them as if they do. So I don't think the froth is in those big names. I think those are some of the greatest businesses we've ever seen in our lifetimes. And they may well deserve their valuations or even be value stocks when you actually value them. And their growth process, including their growth process and cash flow generation. But there aren't hundreds of companies that rhyme with them. And a lot of the market, and the smaller companies are being priced that they'll be the next Amazon, Google, and Microsoft. And I don't see that. So I think that's where I see a lot of the froth. So I think you have to take, as a value investor, each company on its own merits. And so the market isn't really, taking it as a whole, and that we'll make some grand conclusion based on combining it all. We can go stock by stock and say, I'm a value investor. Let me value that business. Okay. Let me value the franchise, how likely it is to grow, how efficiently it is to grow, what kind of returns on capital is going to have over time. Are they going to be sustainable? How great is their moat? All those questions you could do on a stock by stock basis. And I see a big dichotomy in the market between the opportunity set and, like I said, on the long side, we have a very simple strategy that buys all 500 stocks in the S&P and just overweights the ones we think are cheap and underweights the ones we think are expensive by a little bit, because we want to limit the tracking error. Because actually, the philosophy for that fund is, the strategy that's best for you is not only one that makes sense, but one you can stick with. So we're limiting tracking error because we know what people do. They, patience is in short supply. And by the way, the big secret book, the big secret was patience, and patience is in short supply. We now have data, minute to minute. You can check your stock price, every 10 seconds on the internet. Investment managers are judged in very, I used to write quarterly letters when I got started in 1985, and my institutional investors were patient about waiting for them to see the returns. Now, the most anyone will wait is a week to find out, how a private fund is doing. It's patience is a very short supply. Returns are sliced and diced minutely. They're measured with all kinds of statistics that don't mean a lot to us. And if you boil everything down to what I said, is these are ownership shares in businesses that we value and buy at a discount. How much it bounced around over the last 3 months, the stock price, seems a little silly when you really think about it that way. They're not pieces of paper, but that's the way they're viewed. And so I view it as a great opportunity for value investors, meaning if everyone has a short time horizon and you're buying something based on valuation, you ignore what happens in returns in the short term, and you're waiting to wait 2, 3, or even more years for, if you did a good valuation work, the market will agree with you. Not many people can afford to do that. And so it's a great opportunity. Is it a tough business? Is it a tough business for value investing firms, value investing managers? Yes, it is, because time horizons are very short. I think that will continue. So I would say great time for stock pickers, not so great for the value investing business or even the investment business in general if you're not an index.
Gotcha. You know, just to highlight that too, you had a great anecdote in your book, the blue book, if you will. I'm referring to them by the colors of the jackets, but yeah, the blue book. But you mentioned how in the beginning of your MBA courses, you would ask the students to name off a company, and then you would pull up the stock quote in the paper, and you would say, here's its high, here's its low, here's what it's trading at today. So as example, GM, and I'm just throwing numbers out here, it was worth at its high, at its peak, 45 billion, at its low, 15 billion. What does this all mean? And the whole point of that was, we don't know. The market's just crazy, right? So,
well, the market's, you know, over time, the market's really smart.
yeah.
In the short term, it's very emotional. And so the idea, if you have true north, which is valuation, and you're pretty good at it, you don't have to get it exactly. And by the way, there are many companies now that are very difficult to value. There's a lot of disruption going on. New products coming out all the time. It's hard to predict the future. And I ask my students, what do you do with a company like that? And I say, skip that one and find one you can figure out. Yeah. So Buffett has a too hard pile. So there's a lot of businesses in the too hard pile. So, I don't want to opine on Tesla. I just want to say that's in my too hard pile. I don't know if competition will come and make it more difficult for them, or they're 5 years ahead of everyone and they'll stay that way. I really don't know the answer to that question. It's really in the too hard pile for me. But some of these other businesses, and you have to look at things a little differently too. A lot of companies now spend on marketing because they're looking at lifetime value of a customer. And they'll say, hey, if I spend $1, if I spend $2 to get the customer now, I'm only going to make $1 this year on that customer. So I'm going to lose $1 on my income statement, but that customer is going to last 8 years. And I don't have an incremental cost because I got software. So I'm going to get $8. It costs me $2. Right now, it shows me losing $1. But over the next 8 years, I'm going to collect $8. So there's really a lot of change in the way people are looking at customer lifetime value, especially in the software industry. There are a few other industries like that where lifetime value is very important, where you really have to watch your metrics, and they've changed over time, and how you look at how a business is doing. You have to be very careful. What is really CapEx and what is actually should be expensed? And so, we got a lot of CFAs in there. So that definition really should be a business definition. It shouldn't be an accounting definition. And you really have to understand the business to know how to account for that.
All right, we're going to try to, that's really helpful. We're going to try to move through these questions because they're starting to fill up here. So Adam, maybe we can get your input on this one. This is coming from Nathan, and this has to do with accounting adjustments. As we all know, it's much more common today than maybe 20 years ago, the number of adjustments that companies do to get to a core earnings figure. So Adam's question is on the availability of accounting information to enable adjustments that you demonstrate with Bristol Myers. To what extent are all the companies in the S&P 500 transparent in terms of their financial disclosure to make these adjustments? Are there situations where you have to make judgment calls since the company doesn't disclose this information sufficiently?
With regard to earnings, U.S. disclosure quality is pretty excellent in our estimation. So we also analyze companies outside the United States. And the trajectory of this over time is that the SEC has basically tried to equalize information disclosure and push companies to disclose more rather than less. Now, I think there are some issues with regards to how you qualify what is not a lack of information, but too much information, or what we consider something that perhaps isn't germane, where you have a lot of companies who want to describe certain things as not being longer duration costs in their business, one time in nature, and we tend to scrutinize that to a high degree. But the level of disclosure is by design very strong, even if you relate it to what occurred, let's say, in the 1990s and what the government has asked companies to do. And in a way, I think for stock pickers, the level of information and how easily it's accessed makes this business even more competitive than it was years and years or decades ago. But the United States is companies have a very high level of disclosure, and I think the areas of the world where that's not so, they kind of remain so. But the United States has certainly gone in the direction of asking companies to disclose lots of information that makes it fairly easy to come to a view of things in a consistent manner across investors. That isn't to say that you get your work stops at an earnings release or a Q or a K. You need to avail yourself of all the information that companies put out in a variety of different forums, but that's all pretty well regulated at this point.
I mean, are there any specific areas that you get wary of, like within the tech sector? Do you get concerned about stock-based compensation?
Largely no. I think at one point in time it was very different. Look, if we're not of the view, well, I don't know who is of the view other than maybe the people who have positions they want to trade or executives at these companies, that non-cash compensation isn't a cost. I think we're past that with the change in terms of recognition of that compensation. What was it? I think it's 2005 is my recollection. It's been a long time. You could parse out the actual costs of these things, and you might quibble about Black-Scholes or however else it's been modeled, but it's not a huge, and there are a variety of things you want to act as a check in terms of whether these things make sense or not. But I think the bigger issues are in terms of how certain interests represent that cost. That's of no interest to us at all. We recognize those as costs, and I think the requirements that were put in place roughly 15 years ago, pretty good baseline for that type of discussion.
Okay, great. So maybe switching gears here to your allocation strategy. Joel, earlier on in your career, you were running concentrated portfolios. We got a question here from Douglas, though. How has your thinking evolved from running a highly concentrated portfolio to a highly diversified portfolio? And how do you avoid Deworsification, which I think that's a Peter Lynch term, could be wrong, but what's your view on that?
Sure. Well, it's really two different things. There's a lot of ways to make money. The principles are the same. Value a business, try to pay less. You can go long short. You can do a combination of both. In a concentrated portfolio, which I still love that strategy, teach it to my kids and I teach it in class and I love it. It's a full-time job. So is running a big research team and a quant team and a tech team, for portfolio management. And so I couldn't do both. So I would love to do both. They're both great. So I don't think one's better than the other. I will say when you own 6 to 8 names that are 80% of your portfolio, every 2 years, you wake up and lose 20 or 30% of your money because one or two of those ideas either are out of favor for the moment or you were wrong. Okay, you were just wrong. And that just comes with the territory. Most people don't enjoy losing 20 or 30% of their net worth every couple of years. And it's unavoidable. That's what happens. Now, it pays off over a long period of time. Some people can take it, some people can't. The key to that is knowing what you own so that you can sleep even when you're losing money and the market disagrees with you. If you're very confident that what you own just got cheaper, not so bad. But that's fairly superhuman to be able to do that. But it's a great way to make a lot of money, especially if you know your positions well. That takes a lot of time and effort to drill very deep. We found that we can also be right on average. An insurance company doesn't insure 5 people. They could do great underwriting on those 5 people. But if somebody steps off a curb at the wrong time, I don't sell insurance, it messes up your numbers at a minimum, okay? And it's a bad thing for that person. But it didn't matter what your underwriting was. Things go wrong. And so that's why they insure hundreds of people. And we're really good at valuing businesses with a big research team. We're really good. We have an 8-person tech team where we can balance our risks. We're not all in one industry. We're not. and we go long short. So when you go long short and put on leverage, okay, if you had a few names on each side, you're more likely to get aberrationally bad returns sometimes. Over time you'll be right, but you'll have periods of aberrationally bad returns. Either you were wrong or just bad luck. And when you go long short and put on leverage, that results in negative compounding. Negative compounding is bad, hard to make that up. So when you own hundreds of names on the long side and hundreds on the short side, you get what you expect more often. You actually spend less time, even though you went down your list of cheapness and more expensive, you get what you expect more often. And when you go long short and put on leverage, that means you get unexpectedly bad returns, less often, less negative compound. And we actually found when we had a diversified portfolio, we actually made slightly more money, but we got a lot less volatility. So there was no trade-off. So the only way to go long short and put on leverage is you cannot do that in a concentrated portfolio. We went even through the math. Even if you're right eventually, at some point you went broke, or you at least lost a lot of money in the concentrated portfolios. So there's different ways to make money. They're both wonderful. They're just different. I invest with managers who do concentrated. I have most of my money doing the diversified strategies now that we do. And they're both great ways to make money. Take advantage of the principles of good and cheap. And they're both full-time jobs. So I'm not saying one's good and one's bad. They're both good.
Gotcha. That's helpful. By the way, just my mistake. I forgot to give the info to everyone before the Q&A started on how to obtain copies of the 2 books that you wrote. So there's an email address. It's info@gothamfunds, all one word, gothamfunds.com, info@gothamfunds.com. Just you can email them, just mention you attended the CFA Boston event, and they'll be happy to send you your copies. So I wanted to ask you a quick question here about the industry. You're an active manager. You're, of course, looking for alpha. We have a lot of folks that are working in active in the audience right now, and everybody's wondering what the future of active is going to be. We got a question here from Douglas. Given the industry trends towards passive portfolios and away from active, what is Gotham doing to survive this, this active Armageddon that we're going through now?
Sure. Well, once again, what I said is I think this short-termism is here to stay. It's great news for stock pickers. It's terrible news for the active management business. If you take a look at how Morningstar rates funds, if we're just looking at the mutual fund industry, they have 60%, if a fund's been open for a little more than 5 years, 60% is the 3-year return. 40% is the 5-year return, but of course, 60% of the 5-year return is the 3-year return. So now we're up to 84% is the last 3 years, how a fund performed. And all the money flows go to the 4 and 5 star funds, and they only rank stars based on, recent performance. So it's just a lot of performance chasing for funds, and that's what individuals do. They leave the funds that didn't do well in the short term and they go into the funds that did well. So even the funds that outperform don't capture. So there's many things attacking the active managers. So I gave a speech at Google a number of years ago, and I started it this way. I said, even Warren Buffett says most people should just index. And then I said, I agree with them. And then I said, thank you very much. See you later. No, then I said, you know what? Warren Buffett doesn't index, neither do I. How come? So there's a great opportunity for active management. I think if you contextualize it correctly and have a long-term horizon, you can take advantage of it. Will the active management continue to be challenged? I believe so. Is there a place in the portfolio for active management, for good active managers? Yes, there are. For those who can be patient, that's a small number of people. So I wish I could give you more help with that. The way we've addressed it is, I told you about that one, that fund, Gotham Enhanced S&P 500. What we did is say, okay, you know what? The strategy that's best for you is not only one that makes sense, but one you can stick with. So we purposely said we're going to take advantage of active management, but limit the tracking error so that you'll stay with us and collect the active premium. So we compromised. We said we'll outperform by a little less. We've been able to outperform in a very tough period for value, even our type of value. If you're not growth at any price, you would have underperformed. We were able to outperform in this period. So it says it still works. There's still these principles of valuing work. I think they'll get, the future will be much better. We also have something called Index Plus that does the same thing, starts with the S&P, adds a long short overlay. So we've done a bunch of things to say, hey, we're going to do sort of Index Plus type things. We're going to limit our tracking error, take advantage of our stock picking ability. But yeah, even we started as very concentrated portfolios. Forget everything. We're not going to track anything. We're just going to make money. That's our job. We're going to make money in a way where we're not taking a lot of risk. And what I mean by risk is we actually know what the company's worth and we're paying a lot less for it. So I don't know where it's going to bounce around, and I'm very concentrated, but I'm going to be patient enough to collect on my good work. And so that's what I mean by risk. So we're the guys who, we're probably the most concentrated of almost everybody out there. And now we're doing things that are passive tilt, okay, or index tilt. And I don't think we're doing a disservice. I think we have something to bring to the table, and if people are going to participate with us, how can we get them to participate with the fact that we think we know how to value and pick stocks over time? And so we've come up with strategies to address who the customer is. I just watched an interview with Steve Jobs. He said, he was answering one question. He said, there's a lot of technical things that we can do that the engineers can figure out how to do with this gizmo or this software product or whatever it is. But we really have to start with the customer and look at what the customer gets at the end of the day, what the customer sees. And we could add a lot of bells and whistles, and over 10 or 20 years, it may work out, or it may do some special things, but customers aren't going to buy it. So I think with these active tilts, we can help a lot of people, and that's why we're excited about them. Not because I think we'll make the most money from them, but I think we'll make the most money for the end user, which is the customer, because they'll be there to collect at the end. So it's just another way to attack it, but it's a real problem. I think true active managers who don't care about tracking error, they're still going to be challenged. And like I said, great news for stock pickers, not great news for the active management business.
Maybe we can kind of delve into that. Adam, I wanted to kind of get your input here. You oversee the research efforts at Gotham. And as you know, in active management, there's different flavors of stock analysts out there. You have the generalists, you have the specialists, and then you have those that operate under a coverage model where they track every company in their coverage universe. And there are those that are hunters where they're just focusing their efforts on the specific companies, the top ideas. What approach do you find to be the most successful, that has worked out well for Gotham? And what kind of advice do you have for those folks that are aspiring to be, future stock analysts?
Yeah, I mean, well, I'll start by saying what we do is very different than traditional equity research, in the sense that we're not making any projections about the future. So it's a very different thing than what you're doing in virtually anywhere else. And then we have a particular discipline in which we're trying to reformulate what has occurred in the past and to underwrite that across a variety of different means of risk controls. So that lends itself to a generalist approach, in the sense that we're not looking to have if you're doing what everybody else is doing, you need to have, or ideally you would have, an advantage take on the companies in which you invest, and that would become the basis for your belief that you could outperform in picking names, or you be it anywhere from information, which I think is much harder to do than it had been historically, for reasons we discussed a little bit in the prior question, to I think nowadays being able to formulate something that's a little bit closer to wisdom in terms of how you contextualize this information. What we do is different. What we're doing is we're looking purely on the basis of our approach to valuation, something that Joel and Rob have worked on for decades and have tried to systematize in our existing approach. But that lends itself to a very different way of working through companies, which is that if the basis for what we're doing is standardization of information in an idiosyncratic way, which I kind of, that's the basics of it. You want to be able to see through things in a standardized way. And so we're looking through companies and recontextualizing the world in the way in which we would think Joel and Rob would like to see it. Some of the things I would be asked about if I were working on an individual name years ago by Joel or Rob. That's what we do across a couple thousand names roughly. And but if you do the other thing, it's very hard to be a generalist, especially now, given the way in which information is disseminated and the difficulty of looking at a particular niche and thinking, well, I might know more about that because not so many people are looking there. It's much, the world is vastly more transparent in the internet age than it was, let's say, 20 years ago. But our approach is suited towards a generalist approach in a way which I think is less common nowadays.
Got it. So as a transition to this next question, I thought I'd kind of give a little story here. So I came across an article from March of 2000, and it was covering how Cisco Systems was on its way to being the next $1 trillion market cap company. And it was interesting seeing all the quotes from all those Wall Street analysts, and we know how history unfolded, but it's good to know kind of what was the zeitgeist of that era of investing. And now we have the FANGs today. So leading into this momentum that you've talked about earlier, Joel, we have a question from George. You touched on momentum being a potentially short-term flavor of the year. How do you personally determine if a more permanent regime shift has occurred versus a short-term temporary shift?
We don't think about stocks momentum. Like if I came to you and said, give me money, I have a real estate strategy. I'm just going to go out and buy all the houses that were up the most in the last 3 months. That's my strategy. I don't think that would be a very compelling pitch. It wouldn't make sense to you. It might work for a little while. It might not, but it doesn't make sense that I should go do that if there's any valuation beta. If there's no price component in what you're doing relative to value, that's not investing to me. When we make sure that the operating metrics of a business are going well, their margins are good, there are a whole bunch of other things. We want to make sure they're going well, but we view those as risk controls. There's no price component in how well the business is doing. That's a risk control for us because we don't want to buy cheap and not so good. We want to buy cheap and good. We want to make sure it's available at a reasonable price to us. And the business is also doing well. And so to us, that's a risk control. So the difference I would say between a risk control and not is there a price component in it? And even though momentum is based on price, it's not related to value. I would say price related to some kind of value. Momentum is not. It's just price related to price. And I'm not arguing that stocks don't get driven that way. I will just give you one quick anecdote just to tell you, why you don't want to get carried away with, you were talking about Cisco at the top or whatever it is. I was asked to teach a 9th grade class a number of years ago, and I had just lectured to a bunch of doctors. Some of you have heard this story probably before. I lectured to a bunch of doctors and kind of bombed. They just started asking questions. Hey, market was up 1% yesterday. Should I get in? Or oil was down $2. Should I get out? Or whatever it is. And I didn't resonate with them. And then I was asked to teach a semester to a bunch of 9th graders. And I didn't want to fail with them like I did with the doctors, the sophisticated, educated doctors. So I really thought hard and long before I went in the first day of class. And I brought in this, one of those old time jars, glass jars filled with jelly beans. And I passed it around the room to the 9th graders. And I handed out 3x5 cards. And I told the 9th graders to count the rows, do whatever they want to do, write down how many jelly beans they think are in the jar. I collected the 3x5 cards. Then I went around the room one by one, and I asked each 9th grader, how many jelly beans do they think were in the jar? And I said, you can keep your guess, you can change your guess, that's completely up to you. And I went one by one around the room, how many jelly beans are in the jar, and added up those numbers. So when I averaged the guesses on the 3x5 cards, They averaged to 1,771 jelly beans, and there were literally 1,776 jelly beans in the jar. Pretty good guess. When I went around the room asking one by one and writing those down, how many jelly beans, the guess was closer to 800 jelly beans. And I explained to the kids that the second guess was actually the stock market. The 800 guess was actually the stock market, because everyone knows what they just heard, what they just read, who they just talked to. Okay, they're influenced by everything around them, and they had a really bad guess. When they were cold and calculating, counting rows, and very important, independent, meaning they didn't know what anyone else was thinking, they were much, much better. And so the stock market is very much the second guess with the 800, and people get carried away, and it's in retrospect, it always seems pretty obvious, but at the time, there's always stories made up as to why something's going on. And we don't really have to know which companies are subject to that, whether Tesla is or is not subject to that type of thinking. What we have to know, as Warren Buffett would say, is our circle of competence. What actually, are we good at? So if you're picking individual stocks, it would be, do I understand this business, and how am I comparing the price to it? If you're doing, as we're doing, we want to understand that on average, across hundreds of companies, we're really good at what we do. And if we take a diversified portfolio valued in a certain way, we're going to be right on average, and like we're the insurance company, we're going to do that. So either way works very, very well. But you have to know what you're doing. You have to have a home base, and it can't be influenced by everyone around you. So Adam's saying the reason that we don't look forward what's going to happen is because you're influenced by everything around you. We had a 90% fit, just really analyzing the past in a very effective way. When we added our own predictions or other people's predictions or any combination of the above, it really degraded our returns. Of course, you can't pick individual stocks that way, but as a group, you can. So we're trying to be unemotional, valuation-based stock pickers, I guess is the secret at the end of the day.
Got it. That's really helpful. We're coming really short on time, so I'm going to ask one more question from the audience, and then I'll wrap up with a question of my own. So this person actually asked about the famous portfolio manager, Michael Burry of The Big Short. And you have an interesting story with Michael Burry of The Big Short. What drew you to invest with him back in the early 2000s?
Actually, it was very simple. He had a blog of sorts and he was writing up stock picks. And, after teaching for so many years, it's very easy to see a good thinker. And I thought he was an exceptional thinker. So, there was a book written about him a couple of years after his big hit. The way we found him was 5 years earlier, just because he was still writing up very smart write-ups beforehand. So we were lucky enough to find him at a very early time, just based on stock write-ups that he did on the internet. We started something, one of my ex-partners, John Petrie, and I started something called the Value Investors Club, which is still going strong. And it's very, when you see it, you kind of know it after looking through hundreds of applications and grading hundreds of papers. There are certain people, there are people who are certainly capable, but there are certain people that just stand out as logical, good thinkers. And so he was one of them.
Fantastic. So we're kind of coming to the close here. I wanted to end on a question regarding, actually, let me just kind of lay out the anecdote here, just coming from your book. You mentioned that you tell your MBA students that no matter what they do, this game of investing, let's just call it that, is not a be all end all, that really they should be focusing their time and efforts on something that's very meaningful, and they should have some sort of purpose. And with that in mind, I want to touch on your most recent book, Common Sense. What is it that kind of drove you to write that book? It was just released, I think, last month. And what influence are you hoping for that to have, particularly given the very challenging social environment that we are in today?
Sure. I've written it over the last 3 years, so it really wasn't inspired by the pandemic, but the pandemic has brought to the forefront many issues that are covered in the book. And if you've been successful for a while, I tell my students, look, I'm going to teach you something that has been a lot of fun for me, has been very lucrative. but there are better ways to give back. There are more purposeful things you can do with your life. And so I'm hoping that if I teach you this, that you will choose whatever it is to do something meaningful to you that as a way to give back. And one of the areas that I chose, and I wrote about a number of different ideas I had, but one of the areas that's been near and dear to my heart is education. Only one, if you're in the inner city, Black or Hispanic or poor, or low income, your chance of graduating college is 1 out of 11. It's phenomenally horrible. College education, you make 70% more than high school. High school graduation, 30% more than non-high school. So there's a big uptick. And, I got involved with charter schools just as a way to provide another alternative for kids. But I've also studied, and I wrote up in the book, many good district schools that do a good job. And what they show is this, that with the right supports, every kid can accomplish at very high levels. You have kids who are with disabilities, scoring 99%, whole schools where the kids with disabilities pass the math and English tests well over 90%. They beat the wealthiest suburbs, whether it's in Newton or Scarsdale in New York or wherever, they beat the wealthiest suburbs. So it's not the kids' fault. These kids, with the right supports, can achieve at very high levels. What can we do with that information? So one of the things I write about in the book is something called alternative certification, where since it's only 1 out of 11, they're going to get a college diploma. What else, if Microsoft is looking to hire in their HR department, what else can they look for? And what I suggest is that they state what that is. What tests can you pass? What courses can you take that if you do well in them, we will look at you as if you had a college degree. We'll look at what correlates with good performance. And once Microsoft selects what are those courses and what are those tests that you have to pass, there'll be a whole ecosystem of preparation services and tutoring and online resources that will help people train to pass these things outside our current system. Our current system is broken for those kids, but they're very capable. It's very clear with the right supports, they're very capable. So once you have a buyer for their talents, the whole ecosystem to qualify for that, capitalism does work in that sense. It's an end run around the current education system. So I write about it and explain how that could possibly happen and why it should happen and why Microsoft and Google and Facebook could actually change the world by just setting standards. And I write about the earned income tax credit. I write about skilled immigration. I write about banking regulation. I write about retirement savings for, the bottom half don't have any. So I write about all those things in the book to try to make suggestions how an investor would go look at these issues. How would they seek to solve them? And I'm hoping it just starts a debate in the right direction to help some of these problems that are, so pervasive throughout society and then came to the forefront through the pandemic.
So in your view, the education system is ripe for disruption. And do you also view that at the graduate level? I mean, you teach an MBA course, but what relevance is that, do you think, today? I mean, is that also going to be something that's going to evolve over time?
Sure, I think it has to. I think the MBA has to evolve to include more skills. I don't know if there'll be programming skills or dealing, with the online environment. And I think the financial skills that you gain in MBA school can be learned elsewhere. You don't need to go to MBA school for that. I think, to be honest, there's a lot, I teach there and the kids keep getting smarter and smarter and more educated before they come in because they've been working for a while. So I think it's always been a great networking place. I think it's a great way to look for, new careers. So I think it's great for that. And then I think you need to know the basics. So it's helpful for that. But it's a combination of those things that keeps the MBA alive. But I think it has to be even continue to be more skill-based, the learning as things continue on and the world keeps getting disrupted. But you don't have to learn those skills inside MBA school. There's a lot of ways that you can learn how to program or learn finance and a lot of resources and others. So I think, the well-off, college is great and MBAs, but if only 1 out of 11 are getting to graduation, we need to have a system that works around our current system is $1 trillion a year. Very hard to disrupt that. So I discuss an end around to give opportunity to kids who don't make it through the current system.
Okay, great. Well, we are just over time here, so I want to thank you and the whole entire team at Gotham. This has been a great presentation. And before we go, are there any parting comments you would like to give to the audience?
Thank you for joining today. I just hope you stay safe and healthy. And I think the pandemic has brought to light what's important in life. And I think, it's a very tough period for so many people that I know. And I hope we get through this. I know we will. The good thing about this is it's finite. And, we wish everyone well. Want to thank Adam also for really sharing some of his wisdom today as well. And so thank you for that.
Thank you very much for that. I really appreciate it. And yes, on behalf of CFA Boston, we hope you are all staying safe. Remember to visit our website, cfaboston.org. Thanks for joining.